So once again, very warm welcome to all of you in the discussion on Union Budget 2025. I would be covering the income tax proposal, but before I move on to the income tax proposals in the budget 2025, it would be good to understand some numbers, some figures, which are very much important from the perspective of budget. So if we see our deficit trend and and compare it with the previous years, we'll find that the physical deficit is going down. In the last year, it was 5.6 percentage of GDP, and now from 5.6 it is coming down to 4.9. And during the COVID period it went up to 9.2, and the pre-COVID levels were somewhere around 4.6. So we are, as far as physical deficit is concerned, we are very much near to the pre-COVID level. Earlier it was 4.6, now we are in 4.9, which means physical consolidation is happening. And when physical consolidation happens, generally the interest rates comes down, which is a very good indicator from the economy perspective. So if the rate of interest is coming down, if the cost of capital is coming down, it means we'll have more capital to invest in the business, which indeed is a good indicator for the economy and for the businesses. Further, if we see the capital expenditure, which is estimated is around 15 lakh crores, whereas it was last year it was around 12.5 crores, and then the previous revised estimate was 12.27. In 22-23 it was 10.5 lakh crores. So from 10.5 lakh crores in the previous year, we are eyeing 15 lakh crores, which means the government has got focus on capital expenditure. And we all have studied in our school levels or graduation, when the capital expenditure goes up, the it is indeed a good sign. So if I read physical deficit is coming down, the capital expenditure is going up. Uh, it indicates a strong economic growth, uh, where we are heading. So, in my humble view, I feel from an economic perspective, the numbers are good. And if we also see the trend in tax receipts, it is around 11.8%. The budgetary estimate for 24-25 is around 11.8% of the GDP, whereas the revised estimate for 23-24 is 11.6%, and in 22-23 it was 11.3%. So almost the tax receipts are also same from year to year in last 2-3 years. It means the policy frame which government has made for a tax, and the tax collections are happening, they're very much in line with the growth in the GDP. And it also indicates, when we all know that most of the India in India, most of now the people are joining employment or salaries. So it also indicates somewhere that the employment is also increasing. So if we see all these numbers, whether it's deficit, capital expenditure, the tax contributions, uh, it indicates that yes, our Indian economy is in the right track. Though one may see that there is a lot of fluctuation in the stock market, which is considered sort of a barometer for the economic growth, but one can primarily see it in the background of the how the global economy is operating. So if we see the global economy, certainly there are issues in the global economy. But yes, if I talk about India, I think we have got strong or good economy, and we should be doing good in times to come. So nothing to worry. Now, when the budget is made, we know that income tax or GST, the tax bill forms a very important component. And Honorable FM has already announced that we're going to have a income tax bill in the next week, maybe from Monday to Friday. I'm not sure, but yes, we're going to have revised income tax act or revised income tax bill for all of us to read, review, and share our comments. and maybe 6 months down the line, we'll have new income tax act with all of us to explore, to plan, and to execute the same. So apparently, there are very few amendments which have been made in the Income Tax Act, or the amendments proposed in the Income Tax Act are very few. But before that, if we see the entire, what was the thought in the mind of a government while drafting a budget, they said there are four engines for development. One is the agriculture, second is the MSME, your third is the investment, and fourth is export. So the entire budget is around these four pillars: agriculture, MSME, investment, and exports. And if you once will go to the Income Tax Act, we will see that lot of proposals are primarily towards encouraging the investments in India and to make India as a financial capital. We all know that in the recent past, in last 20 to 15 or 10 years, we have done a good export of services. And now I think we are eyeing to become a financial capital of the world, wherein the people are coming and investing in India. And that's the reason a lot of amendments have been made, a lot of relaxations have been given to IFSC or the units operating in IFSC. We're going to see that. Uh, as far as these four pillars are concerned: agriculture, MSME, investment, and exports, a lot of new schemes government has announced, uh, which primarily primarily going to will bring the stability in the agricultural sector. So a lot of hybrids, you will find seeds on which governments are working, which should not have much impact of weather on them. Now coming to MSME, you must have seen or you must have read that the limits for MSME have been proposed to be increased. The investment limit has been proposed to be increased by 2.5 times, whereas the turnover limit has been proposed to be increased by 2 times, which means the scope of MSME will going to increase. And if scope of MSME will going to increase, the benefit or the schemes which are available to MSME will also going to increase. It also indicates that the applicability of Section 43BH in the Income Tax Act will also going to increase. So now the revised, as per revised, the thresholds, the micro enterprise would be the one wherein the investment is 2.5 crores or the turnover is 10 crores. And the turnover is 10 crores. Earlier it was 1 crore and 5 crore, 1 crore investment and 5 crore turnover. Small enterprise would mean wherein the investment is 25 crores and the turnover is 100 crores. Earlier it was 10 as investment and 50 as turnover. Medium enterprise means 125 crore as capital investment and 500 crore as turnover. So the 43BH we all know is applicable on micro and small enterprises. So earlier it was applicable on a company having a turnover up to 50 crores. Now it will move on from 50 crores to 100 crores. So a lot many other companies, yes, who was registered under Udyam 1 would now be eligible to have the MSME benefits, including the benefit of early payment, which is given in 43BH. So there is also enhancement of credit availability and guarantee cover to the MSME in this budget proposals which government has made. Earlier, the guarantee cover was 5 crore. Now from 5 crore, it has been increased to 10 crores. And also the additional credit of 1.5 lakh crores is expected to be given in over next 5 years. There is a guarantee cover being increased for the startups also, and also the sunset clause which was there in the Income Tax Act has been increased to 2030. Now you can have a startup up to 2030. The guarantee cover is increased from 10 crores to 20 crores, and also the guarantee fee has been moderated for the startups. The credit card would be introduced for micro and small enterprises. There would be a fund to the tune of 91,000 crores. Now the new fund would be introduced with 10,000 crores. So a lot of benefits are coming for the MSME and startup, and also which I like most, government is coming up with scheme for first time entrepreneurs, and those first time entrepreneurs will include women, scheduled caste and scheduled tribes, and the government will going to give a support of 2 crores rupees to those startups, to those first time entrepreneurs. On the investment side, government would be investing in people. So you will find that now adult tinkering labs, which might be there in your kid's school, now government is planning to expand those adult tinkering labs to 50,000 government schools over next 5 years. So these adult tinkering labs would going to act as a seed for innovation, and when India is eyeing to, we would be completing 100 years of independence in 2047. We're going to have a lot of innovation by that time, and these young kids who would be in schools working in adult tinkering labs or gaining knowledge from adult tinkering labs, would going to add growth to India and much needed technological support to India. AI for education, I've already spoken many times on AI that AI is must, and as you eat every day, as you sleep every day, you must invest your 15 to 30 minutes every day in understanding AI. So government has planned an outlay of 500 crore rupees on AI for education, which is again not a small amount. Now, let's move on with this to our income tax proposal. Let me share my presentation. Just give me a minute. So now I trust my presentation is visible to all of you, and we are ready for discussion on the income tax bill. So first, let's discuss corporate tax. There are no major changes or no changes in corporate tax rates. Uh, Whether it's section 115 BAA or 115 BAB, the tax rates remain same. And also there is no extension with regard to 115 BAB. One needs to start manufacturing by 31st March 2024. That debt has not been increased. So whether it's tax rates, whether you're opting for concessional tax regime or you're not opting for concessional tax regime, there is no change in the tax rates for corporates. And also there is no change in tax rates for foreign companies. Last year it was brought to 35%, and still it is 35%. Yes, there are changes in the personal tax rates, and it is very much important for all of us to understand. See, earlier the limit was, under 87A, it was 12,500. Few years back it was increased to 25,000, and now from 25,000 it has been increased to 60,000, a tax rebate under 87A, which is a very substantial amount. So now till 12 lakhs, you will not find any tax. If your total income is 12 lakh or less, you will not need to pay any tax to the government. These are the revised slabs. Again, a good jump in the tax rates. One can see not good jump in the sense one can see that the new slab have been introduced from 20 lakhs to 24 lakhs, and the rate is 25%. And it starts from earlier 3 lakh, now 4 lakh. No nil, no tax till 4 lakh. From 3 to 7 earlier, now the slab is from 4 to 8, 5%. The third slab, 7 to 10, is now 8 to 12. One can see earlier it was 3 lakh, 7 to 10, 3 lakhs was the range, and that range has been increased to 4 lakhs. And the rate is 10%. From 10 to 12, again, the range is 2 lakhs. And now you can see that range from 12 lakh to 16 lakh, and the gap is 4 lakh. Tax rate is 15%. From 12 to 15, the gap was 3 lakh. Now it is 16 to 20, 4 lakh gap is there. The rate is 20%. So one can clearly see that government wants to give benefit to the individuals or the taxpayers who are following the slab rates. And the idea is apparently, one may say that because of the inflation or because of some other reason, because of the elections. But from an economic perspective, it simply means if you are saving more, if you are paying less taxes, you will going to put that money either in the savings or in the consumption. Uh, Certainly, this consumption would going to give boost to the Indian economy. Um, so, given the fact that government is increased the expenditure on the capital side, and if we get the proper push from the reduction in the this income tax rate, and if we get the proper push in the consumption side, I think it will make a good combination for the economic growth. This is very interesting. Amendment has been made in updated return. Earlier, one was allowed to file the updated return for 24 months, wherein if one is filing the updated return for 12 months, up to 12 months from the end of relevant financial end of assessment year, one needs to pay 25% of tax plus interest. And if it is from 12 to 24 months, it is 50% of tax plus interest. But now it has been extended to 48 months. And if you see, if you are filing the updated return from 24 to 36 months, what additional you need to pay is only 60% of tax plus interest. From when we are traveling from year one to year two, you can see there is a jump of 25% to 50%, almost double. But when you're traveling from year two to year three, oh, see this, it's a very marginal jump from 50% to 60%. That is uh, 10, so 1 by 2, almost 20% jump is there. But from year one to year two, you can see it is all doubled. So though they have given the years, they have given you the more years, but the increase in cost in relation to the earlier years is very less. So if there is a delay, if you're filing an updated return within 12 months, what you're paying is 25%. But if after 4 years, if you're filing after third year, but within 4 years, what you are only paying is 70%. So the cost, if I see evaluated from the cost perspective, even if we opt to file an update in the third year, it is not costly in comparison to year two. But yes, from year one to year two, the cost has increased substantially. One can certainly file updated return up to 3 years without any issue. But yes, if it is beyond 36 months and within 48 months, if notice has been issued, show cause notice has been issued under 148A, then it restricts you to file an updated return. So now let's say if your taxpayer or if you have forgotten to disclose any foreign assets, and if you feel there is a valid sources, and there is a time for you to file the updated return is there, then you can always file the updated return, disclose the foreign assets, disclose the sources, and it will avoid penalty provisions or even the investigation from a foreign asset units too. I think it's a wonderful initiative by the government, and this will avoid the litigations. Cost is not much, and if in nutshell, if you can use this provision of updated return, you should use this. uh, I, I I know people are saying it is acting as a voluntary disclosure scheme. uh, then also there are no issues, because if you can take the advantage, take the benefit, why not to file the updated return and disclose, make the proper disclosures. Now, as far as salaries is concerned, there is not much change except in the perquisite. Earlier, the limits were given in the act that the monetary benefit to the employees were allowed to the tune of 50,000 rupees. And if any employee is traveling outside India, and if there is a travel related expenditure for the medical benefit, and the salary is less than 2 lakh 50,000, then in that case, the benefit was given to the employee and it was not considered as a perquisite. But now what is happening, instead of defining the limits within the act, the amendment has been made that now the government would be coming up with the limits as may be prescribed. So maybe through a notification or through a rule, they may come up with the revised limits. And if I read memorandum explaining the finance bill, they are specifically using the word increased. So hopefully we'll have a better limits through notification that will going to come. In the house property, earlier the section was where the property consists of house or a part of house which is an occupation of the owner for the purpose of his own residence, or cannot actually be occupied by the owner by reason of the fact that owing to his employment, business, or profession carried on at any other place, he has to reside. In that case, annual value was considered nil, but there was a reason, and the reason was owing to his employment, business, or profession. Now, the benefit is still there up to two properties, but the best part is now the reason has not been defined. They're saying for his own residence or cannot actually occupy it due to any reason. So if you have got two house property, you are not able to occupy one house property because of X, Y, Z reason, then also till two house properties, the annual value would be considered nil. Earlier, one used to consider nil only when there is a non-occupancy because of employment, business, or profession. Is my slides visible? Someone text me that slides are not visible. Can somebody confirm my slides are visible or not? Visible. Thank you. Thank you, Viniji. So I hope I'm clear on this house property point. And now let me move on. This is a new section is introduced under income from PGBP, presumptive taxation. Again, it suggests what the government is thinking. See, in order to encourage Make in India, and specifically in order to encourage electronic manufacturing facility in India, government has introduced the Section 44 BBD. Now, what will happen if you are using a service of non-resident? See, where an SSC being a non-resident engaged in the business of providing services or technology in India for the purpose of setting up of electronic manufacturing facility or in connection with manufacturing, producing or electronic of goods. In that case, the income of such non-resident would be considered 25% of the aggregate amount received by that non-resident. And the tax that would be payable would be 35% of 25%, which will even going to be less than the 10%. What we want to encourage? We want to encourage companies. They are setting up electronic manufacturing facilities. and more importantly, chips, the semiconductors or chips manufacturing facilities in India. So now, if the foreign companies are owning those technology and they wish to open a subsidiary in India, or they wish to do a joint venture and open a company in India, I think this sections give them a benefit that what the tax they need to pay is even less than 10%. So it's a very benefit, but I'm not sure very beneficial for the non-resident. But just because they need to pay a low tax in India, they will going to come down to India is, I think, is a tough point, because what you need is proper infrastructure. Also, when you want to manufacture a chip or semiconductors, but yes, government is working on the same also. So hopefully, we're going to see some new manufacturing facilities in India because of this section. May not because of this section, but yes, it do suggest that government is eyeing to import technology or services for setting up of new manufacturing facilities in India, specifically related to electronics and information technology. Again, to attract the sovereign wealth fund, uh, so to attract long-term capital fund from sovereign wealth funds, the time limit has been extended from 31st March 2025. So it grants an exemption to them from dividend interest, long-term capital gain. Now this period, that they need to make investment on or before 31st March 2025 has been extended to March 31, 2030. So the objective is to bring more investments in India through sovereign wealth funds or through pension funds. So they have been given more opportunity that yes, not only by 31st March 2025, you wish to invest more by 2030, you can do it. And nobody knows, we might see, some more investments from the US, maybe Honorable President of US, Donald Trump, through a sovereign fund may invest in India. That is the objective of this section. Also, because of last year we had a Section 50 AA, which treated unlisted debt securities as short-term gain. So now that has been rectified, and now even if it is a short-term gain, one would get exemption. That is, sovereign welfare funds and PF funds will get exemption under Section 1023 FE. There used to be some issue, not technically it was issue, that what should be the status of securities held by investment funds. Though there was a lot of clarity, but now they have brought in to make it more clear that if any gain is arising from the securities held by investment funds, that would be treated as taxed as capital gain. This was what I was discussing in the beginning, that the objective is to bring the investment, and a lot of amendments have been made with regard to IFSC. So you can see, there is a long list that in all these cases, the time limit has been extended to 2030. So whether it's Section 9A benefit, 10(4)(d), 10(4)(f), 4H, 47(7)(ac), AD, 80 LAD. In all these cases, they have given the benefit of IFSC till 31st March 2025. And now the same has been extended to 31st March 2030, sorry. So in life insurance policies, again, the benefit given to IFSC. So if there is a premium over 2.5 lakhs, and in other policies, in ULIP policies, it was 2.5 lakhs, and in other policies, it was 5 lakhs. One does not get a benefit of Section 1010D. So in order to attract that non-resident should buy policies from the insurance company, life insurance policies from the companies operating in IFSC, they have removed this cap. So now it has become, attractive for non-residents, that instead of buying life insurance policy from a company operating outside IFSC, for example, in Singapore or maybe in other part of the world, so why to buy this policy from Singapore? Why not to buy a policy from India? So again, the idea is to bring or to make IFSC or India as the financial capital of the world. They have made one more amendment in 10.4e, which exempts specified derivatives, income from specified derivatives with IFSC banking unit. So if any non-resident is having a transaction with specified derivatives, and those derivatives are issued by the banking units operating from IFSC, those incomes are exempt under section 10.4e. Now what they have done, that not resident is not only can buy or transact with the banking units, that advantage have been also given to foreign portfolio investors. So if a non-resident is doing trading derivatives transaction with FPIs, that is foreign portfolio investors operating through IFSC or in IFSC, in that case also the benefit would be available, and the income which is getting generated would be exempt. There is again an advantage to the IFSC given. So there is a tax neutral offshore fund relocation benefit is there under 10.10d, which is there. So under the current regulation allows a tax-free reallocation of the fund to the category 1, 2, or 3 AIFs. Now the same have been extended to the retail scheme. So if there is any retail scheme which is operating outside India, and if the fund wants to shift that retail scheme or ETF scheme to IFSC, then they will get the exemption. Also, the benefit of deemed dividend is given. What happens if you give a loan to a closely held companies, then the same is treated as deemed dividend. So certainly a lot of financial companies are operating in the IFSC. So there is a risk that if such transaction will happen, the same could be treated as deemed dividend under section 222E. Now, what they have done, they have given a benefit that it is proposed to amend to exclude loans and advances between group entities from deemed dividend if an IFSC financial company or unit acting as a treasury center and its parent principal activity entity is listed on a foreign exchange. So if there is a foreign listed entity which has got treasury center at IFSC, and if there is a transaction between them which is in the nature of loans or advances, then such loans or advances would not be treated as deemed dividend. So one can clearly see the vision of government, or that we need to give as much as benefit possible to IFSC to make it competitive with the other financial centers in the world. And certainly this will attract the capital in India. Now, after IFSC, there are other changes also which I have not discussed. There are small changes. But now we can move on to a very important amendment in section 72A with regard to carry forward of losses in case of amalgamation. So what used to happen when there used to be an amalgamation, the amalgamated entity, so let's say there is entity 1 and entity 2. Entity 1 is carrying a loss. Now the entity 1 gets amalgamated with entity 2. Now, whenever that entity gets amalgamated with entity 2, from there we used to see the 8 years. And now if entity 2 gets amalgamated with entity 3 after 5 years, those 8 years will again get a new life. And after 5 years, 5 plus 8, 13 years, you would be able to carry forward the losses. So this used to be a kind of an evergreen provision that whenever you want to carry forward a loss and whenever the timelines are elapsing, why not to amalgamate it with any other entity? I think government got this point. Now they have clarified that the loss can be carried forward only for 8 years, and we need to see 8 years from the original entity, when the loss was first booked. So if entity one is the original entity which has first booked the losses, from that period we're going to see the 8 years. So even if the amalgamation is happening, so let's say amalgamation happened in the fifth year, then you have only the amalgamated entity, or the new entity which is getting formed will have only 3 years with it. The 5 years have already elapsed. So this is a very important amendment which has happened in section 72A. For the startups, I have already discussed that the timeline have been increased from April 2025 to April 1, 2030. So new 5 years have been given, that if any startups starts on or before 1st April 2030, in that case, the benefit of ATIAC would be available to such startups. But yes, the other conditions which are required to qualify as a uh, startup under Section 80 that needs to be fulfilled. Transfer pricing. So what is happening in transfer pricing currently? Interesting change. I'm not sure how successful this amendment would going to be, given the fact how the assessment happens in India. Uh, so when the case is selected for the scrutiny, as far as TP is concerned, the matter goes to the transfer pricing officer. The TPO evaluates the case and they come up with the order. Once the order is received, if it is clean, it's good. If it is not clean, then the taxpayer has got the option either to go to the DRP, or after receiving the draft order, or to go and file the Commissioner of Income Tax appeal with the Commissioner of Income Tax Appeals. So now this amendment gives the advantage to the taxpayer that if he receives when he receives the transfer pricing order, he can opt to apply the pricing determined by the TPO over next 2 years. So the SSE needs to file an application that I am fine with the price you have computed, and I would be happy to apply this price in next 2 consecutive years on that transaction. Now, if the TPO agrees to the application of the assessing officer, he needs to give his view within a 1 month. And if he agrees, then the next the assessment will not happen. It is just that because you have accepted the price, the next 2 years would be evaluated on those price, and if required, the relevant amendment would be done to your return. But the question comes, if we see the transfer pricing assessments, the way they happen, it's very pro-revenue, very aggressive. So whether assessee will agree to those pro-revenue approach or not is the big question. Though the intention looks good, but I think if we see how the orders are, what happens to the assessment done in the ITAT, if we see tribunal orders, they are generally in the favor of the taxpayers. So if I think there would going to be very less chances that assessee would going to accept the approach of the transfer pricing officer wherein there is an addition. Wherein there is no addition, when the assessee gets a clean order from the TPO, in that case, the assessee may like to apply the order of the TPO, but I think again that is very subjective. So when I am accepting, so whether the same range will apply, same companies will apply, what will happen? Whether one needs to see the additions or the arm's length price, not in the range, but in the median. I think that is slightly more confusing. So in my view, government should come up with the clear examples that how under various cases those prices would be applied over next 2 years in order to mitigate any litigation arising from this initiative, which is indeed made to reduce the litigation. So there should not be any litigation, and in order to avoid any litigation, one should come up with clear regulations along with the examples. And I must compliment government. First time I think they have brought in the FAQs around the budget. And those FAQs, I think they released in next day or next to next day. So I think I have seen first time government coming up with the FAQ within 24 hours or within 48 hours of the budget, explaining various changes made in the Income Tax Act, changes proposed in the Income Tax Act. Significant economic presence. So everyone is appreciating it as a very um, significant change or a very good amendment which government has made. But if you ask me, I think we need more such clarifications. So significant economic presence is a concept in the business connection in Section 9. We know that Section 9 is a deeming provision, which says that if you have a business connection in India, your income would be taxable in India. It is generally applicable on non-residents. So you can have business connection if you have an agent in India, or there is some physical presence in India, or if you have a significant economic presence. Now, under significant economic presence, you practically do not need physical presence in India. There are thresholds, and those thresholds are that you have what you say that there is a number of users, specified number of users, or you have entered into specified the transaction value is more than 2 crores in aggregate. If you entered with a resident in India or a non-resident in India, but some entity in India, then in that case, you will have significant economic presence in India. So the issue arises, what will happen to those cases wherein we are exporting goods from India to outside India, whether export of goods would be covered. So now through this amendment, they have clarified that exports of goods would not be covered. If exports of goods would not be covered, does it mean import of goods are still covered? So they have excluded purchasing goods in India for exports. So if non-resident is purchasing goods in India and exporting them, then certainly it is not covered. But yes, it do indicate that if you are importing goods in India, and if the aggregate value of such imports, or let me put it this way, if you are exporting goods in India, and if the aggregate value of all such exports is more than 2 crores, then you will fall within the provisions of significant economic presence. Now, in order to come out from these provisions, you can have the treaty benefit. And in order to take generally in treaties, you will find SEP concept, significant economic presence concept, is not there in the tax treaties. And in order to apply tax treaty, one needs to have uh, tax residency certificate and Form 10F that you need to submit to the taxpayers in India. And if I take it, from if I speak it from the perspective of taxpayers in India, in such case, taxpayers must, if let's say, I'm the taxpayer, I'm a resident, I'm importing goods, the question comes, at what rate should I deduct the TDS? Some of you might be thinking, hey, there is no TDS on the goods. But friends, if the non-resident has got significant economic presence, then there could be TDS applicability. Now, let's say you have imported a good worth rupees 50 lakh, but there are other importers also, and they have also imported, 50 lakhs or 60 lakhs, and the aggregate value of all the imports made in India from that non-resident is more than 2 crores, then in such case, that non-resident will have significant economic presence in India, and which means that such non-resident has got business connection in India, and you must deduct proper TDS on the payment made to such non-resident. And in order to avoid the situation, what you need to take, you need to take tax residency certificate of that non-resident for that year, along with Form 10F if applicable, and then you can give the treaty benefit to that non-resident. So hope I'm clear on this important amendment and what this amendment is indicating. It is indicating that now they are saying, hey, look, export of goods, nothing to worry. If you are exporting goods from India, if you are buying goods from India, nothing to worry. But they're still silent on if you are exporting goods to India. If it is exporting goods from India, no worries. But if exporting goods to India, one needs to watch out the applicability of SCP. Now, coming to TDS, TCS provision, a lot of thresholds have been changed. Not much to speak on this. One can go to the Excel files or the tables and see in the thresholds. I think the important threshold which has been changed is 194I rent. Now earlier it was 2,40,000. Now it has been made 50,000 per month. So it is 50,000 per month and not 6 lakhs per annum. That is something you need to watch out. So let's say even if you are paying for 3 months, 50,000 into 3, 1,50,000, which is less than 2,50,000, which is even less than 6 lakhs, then also the TDS provisions would be applicable. And for the friends who are a partnership firm or who are dealing with partnership firm, you also need to watch out the new section 194R, 94T, which is applicable from 1st April 2025. A relaxing provision, one should say that now there is a removal of higher TDS and TDS in case of non-filers of ITR. The sections 206AB and 206CCA has been proposed to be omit from this budget. A very welcome change, and we all know that omit, there is a difference between delete and omit. Delete happens from that year, and omit happens since it brought into the picture. Also, if there is a delay in depositing the TCS, there is a benefit. The section 276BB now gives you more time. Now it gives you a quarter that if the return is not filed, if TCS has been collected and you have filed you have submitted or deposited the TCS before the deadline of filing the return, that is a quarterly, it's okay. So one needs to deposit the TCS now before the return filing. Timeline for imposition of penalty under section 275. I think this gives us a hint where and what kind of income tax bill we're going to get. So this is a clear-cut example of simplification which has happened. So if you see the current provisions of 275, there are there are different time limits. If there is a tribunal order relating to penalty, in such case, the time limit is uh, 6 months. In other cases, it is 1 year from the end of or from the receipt of that order. So now instead of having different time frames or time limits, the it has been proposed that we will see 6 months from the end of quarter in all the cases. I'm hoping we're going to get a similar, I will say, ease of reading the act when we would be reading the income tax bill, which we are expecting in next week. So this is a simply clear-cut example of simplification which is happening in the Income Tax Act. Now, with regard to crypto assets, the new section has been introduced, section 285BAA. And under 285BAA, the Indian government wants the entities to submit the statement. What entity? I don't know. That would be called as a reporting entity. Certainly, those reporting entity could be the crypto exchange or the companies who is maintaining the crypto wallets. So whether those entity could only be Indian entities or those entities could be foreign entities as well is something to watch out. Let's wait for the notification on this. But if you ask me, I think it they might extend the scope to entities outside India as well under section 285BAA. So they might say that if this much of thresholds or this much of transaction has happened, you must file the details in India. But we need to wait on this. But for sure, the government is increasing its scope or coverage when it comes to the crypto assets. Charitable trust, some interesting amendments again to benefit the charitable trust. So till now, the registration process is that if you have been registered, the registration has been given for 5 years, and after that, one needs to go for a renewal. But now, if you qualify as a small charitable trust, that is, if your income is less than 5 crores before giving the benefit of Section 12, before giving the benefit of Section 11 and 12, in such case, uh, now you are not required to renew for 10 years. So instead of 5, the one will see 10 years. But this is only applicable for small charitable trust. That is those charitable trust who are having income less than 5 crores before giving the benefit of Section 11 and 12. The another benefit which has been given to charitable trust is under Section 13, wherein the substantial donor or the specified person is defined as the donor who gives more than 50,000 rupees plus their relatives plus their interested entities. Now, what the amendment have they been proposed in the finance bill? What amendment they are bringing is that such substantial donor would be the one who has given rupee 1 lakh per year or 10 lakh aggregate over past years. So the limit has been increased. The substantial contributor or substantial donor, the limit has been increased. And from the specified persons, the relative and related concerns are dropped. Now, only that donor would be considered as a person, specified person under Section 13, and not his relative or related concerns would be considered a specified person under this new proposed regime. So I think I'm done with my quick discussion on budget 2025. If you have any questions for me, I would be happy to take up those questions. So I don't think there are questions.
Gaurav ji, अगर if you are paying rent by only 3 lakhs per year, 30,000 per month say, then GST TDS liability is there?
No, sir, because it is less than 50,000 per month.
Okay. Right. Thank you.
Thank you. Thank you, sir.
Why this per month concept is there? I don't know.
पर मंथ सर क्या कहें इस पे तो जो
नहीं
भी
तो 6 lakhs per annum और okay.
सर एक्चुअली देखिए both points, both ways have got this own merit. Why government shifted from per annum to per month? Tough to say, but being they are giving a limit of 50,000, which is indeed on the higher side. तो अगर कोई 50,000 रुपये रेंट ले रहा है तो गवर्नमेंट मान के चल रही है कि यार ऑन दी हायर साइड ही है, तो इसलिए उसको शायद पर मंथ कर दिया होगा.
Okay. Okay, thanks for the nice session.
Thank you, sir. So thank you, friends. If you have any question for me, feel free to write back to me. May not be अभी आपको शायद नहीं आ रहा हो, कोई दिक्कत नहीं है. You all have my WhatsApp number. You all have my connects. Let's connect over the phone if you have any questions or if you face any challenge in analyzing the provisions of Finance Bill 2025. Thank you.